What if I told you that one of the most beaten-down names in EV charging just pulled off a financial turnaround that could signal a major shift in the industry? ChargePoint just dropped their Q3 2026 earnings, and the numbers tell a story that Wall Street wasn't expecting. From massive debt reduction to revenue growth finally returning, this could be the inflection point investors have been waiting for. Let's break down the top 10 takeaways from this game-changing earnings call, counting down from number 10 to the most important revelation. At number 10, we have inventory management strategy. ChargePoint is making strategic decisions to wind down certain commitments with contract manufacturers. While this temporarily adds some components to inventory, management expects a small decline in Q4 and, more importantly, a material decrease throughout the next fiscal year as they sell through existing inventory. This disciplined approach sets the stage for improved margins ahead. Number 9 brings us NEVI momentum returning. After a period of uncertainty, the National Electric Vehicle Infrastructure Program is back on track with over 40 states now actively awarding contracts. ChargePoint is participating in many of these projects and recently completed an installation in Pennsylvania. This federal support provides a steady baseline of demand going forward. At number 8, Europe emerges as a growth engine. Management is particularly bullish on the second half of calendar 2026, with significant opportunities emerging across key European markets. CEO Rick Wilmer personally met with European customers who showed overwhelming enthusiasm for ChargePoint's new products, particularly the DC architecture. This geographic diversification could be crucial for sustained growth. Number 7 highlights the Eaton partnership exceeding expectations. The collaboration with Eaton has unlocked more innovation than initially anticipated. They're shipping co-branded products and have developed differentiated solutions, including vehicle-to-home technology and DC-only fast charging systems. This partnership is proving to be a competitive advantage in the marketplace. Coming in at number 6 is groundbreaking product innovation. ChargePoint's new DC product line, ChargePoint Express powered by Eaton, can be deployed with up to 30% lower capital expenditure, occupies a 30% smaller footprint, and reduces ongoing operational costs by up to 30%. Their new AC product line integrated with Eaton's smart technology eliminates expensive panel upgrades, making EV charging more accessible and affordable. At number 5, we see the BMW partnership launch. ChargePoint announced an exciting program with BMW North America to transform select premium locations into destination charging stations for EV drivers nationwide. Site host recruitment is underway, and this partnership with a major luxury automaker validates ChargePoint's technology and market position. Number 4 showcases record subscription margins. Subscription revenue reached a record 63% gross margin on a GAAP basis and even higher on a non-GAAP basis. This was driven by economies of scale and ongoing efficiencies in support costs. With subscription revenue growing 15% year-over-year and representing 40% of total revenue, this high-margin recurring revenue stream is becoming increasingly valuable. The number 3 spot goes to massive debt reduction. ChargePoint completed a debt exchange that will ultimately reduce total debt by $172 million, more than half of the previous balance. They secured this at a 33% discount, eliminated an $82 million change of control premium, reduced annual interest expense by $10 million, and extended maturity from 2028 to 2030. This is transformative for the balance sheet. At number 2, we have exceptional cash discipline. Third quarter cash usage was only $14 million, significantly better than the $24 million in the prior year quarter. More impressively, over the last 4 quarters, net cash usage was less than $39 million compared to $178 million in the 4 quarters prior. This dramatic improvement gave management confidence to execute the debt reduction and shows operational excellence. And the number 1 takeaway, revenue growth has officially returned. ChargePoint delivered $106 million in revenue, crushing guidance of $90 to $100 million. This represents 7% sequential growth and 6% year-over-year growth. Network charging systems grew 12% sequentially and 7% year-over-year. After quarters of decline, growth is back, and management expects it to accelerate in the second half of calendar 2026. Combined with record 33% gross margins and improving path to profitability, ChargePoint may have finally turned the corner. The EV charging infrastructure story isn't over. It's just getting started. Drop your thoughts about ChargePoint into the comments below, and don't forget to subscribe for more earnings analysis from Earnings Central.